What you need to know about the Fed's interest rate hike. The decision by the Federal Reserve to raise interest rates is prompting concerns about the potential for a recession. Higher interest rates make it more expensive for businesses and consumers to borrow money, which can lead to slower economic growth and even a recession. While it's too early to know for sure if a recession is imminent, the Fed's decision to raise interest rates is certainly a concerning sign. The economy has been growing steadily in recent years, and it's possible that the Fed's actions could derail that growth. This is Capitalist Domain, and in today's video, we're going to talk about the potential risk of a recession due to the Federal Reserve's monetary policies. What is the role of the Federal Reserve? The Federal Reserve, or the Fed as it's called, is the central bank of the United States. It's responsible for conducting monetary policy, which includes setting interest rates and regulating the money supply. The Fed also supervises and regulates banks to ensure they are sound and stable. And it provides banking services to depository institutions like commercial banks, credit unions, and savings and loans. A recession is a period of declining economic activity, typically defined as 2 consecutive quarters of negative economic growth. During a recession, businesses may experience reduced demand for their products and services, leading to layoffs and lower profits. Individuals may also see their incomes decline and their savings dwindle. The Fed's main tool for conducting monetary policy is setting interest rates. When the economy is strong, the Fed will typically raise rates to cool things down and prevent inflation. But when the economy weakens, the Fed will cut rates to stimulate economic activity. The problem is that in a recession, cutting rates may not be enough to jumpstart the economy. That's because when rates are already low, there's not a lot of room to cut them. And if rates can't be cut any further, the Fed has fewer tools at its disposal to fight a recession. Another risk is that Fed's policies could unintentionally cause inflation. If the Fed prints too much money or keeps interest rates too low for too long, prices could start to rise. That would be a bad news for consumers and businesses alike, as it would eat into their purchasing power and profit margins. So while the Fed's policies can help stave off a recession, they also come with risks that need to be considered. During an economic downturn, the Fed will have to tread carefully to avoid making things worse. Fed's decision to raise interest rates. This month, the Federal Reserve has announced that they will be increasing interest rates by a 0.5 percentage point in order to get control of the inflation which has been seen lately. The Federal Open Market Committee raising interest rates for the first time in 22 years was unanimous, with all the 12 members agreeing to hike it. This decision will have an effect on everyone from banks and mortgages as well as how much consumers can borrow. So keep your eyes peeled. So why exactly did the Fed decide to raise rates now? Simply put, inflation is getting out of control. The global pandemic has led to an increase in demand for certain goods and services, while at the same time the supply for goods and services has decreased. This means that prices are going up, and the Fed wants to get ahead of that before it gets out of hand. The thing is, raising rates too quickly could also lead to a recession. So the Fed will have to tread carefully in order to avoid hurting the economy. What does this mean for you? The Federal Reserve's decision to raise interest rates could have a big impact on your finances. Here's what you need to know. If you're a business owner, higher borrowing costs could put a strain on your bottom line. If you're a consumer, higher interest rates on things like credit cards and loans could leave you with less money in your pocket. And if you're someone with savings, higher yields on your investments could mean more money down the road. No matter who you are, the Fed's decision to raise rates will have an effect on you, so it's important to stay informed and make sure you understand how this change could impact your finances. Raising interest rates is not the only way the Fed can impact the economy. The central bank also has a tool known as quantitative easing, which is when the Fed buys bonds from banks in an effort to free up money and spur lending. Quantitative easing has been credited with helping to boost the economy out of the Great Recession, but it's also been criticized for creating asset bubbles and stoking inflation. How could a recession impact everyday Americans? A recession could have a number of impacts on everyday Americans. One impact could be a job loss. As businesses struggle to cope with the economic downturn, they may cut back on staff or even close their doors altogether. This could lead to an increase in unemployment as well as a decrease in wages and incomes. Another impact of a recession could be a decline in the values of investments and savings. As asset prices fall, Americans who have invested in stocks or other assets could see the value of their portfolios decline, and savers could see the interest rates on their deposits fall, eating into their earnings. For example, let's say you have $10,000 in a savings account that pays 2% interest. If the interest rate on your account falls to 1%, then you'll only earn $100 in interest for the year instead of $200. A recession can also cause a decrease in home values. As people lose their jobs and incomes decline, they may have difficulty making their mortgage payments. This could lead to more foreclosures and a drop in home prices. Lastly, a recession can lead to an increase in borrowing costs. As businesses and consumers default on loans, lenders may become more hesitant to lend money. And when they do lend, they may charge higher interest rates to offset the increased risk of default. All of these impacts could have a serious effect on the everyday lives of Americans. So it's important to understand what causes recessions and how they can be prevented. How to know if a recession is happening? There are a few key indicators that economists look at to determine whether or not a recession is occurring. One is gross domestic product or GDP. GDP is the value of all the goods and services produced in a country. If GDP growth slows down, it can be a sign that a recession is on the horizon. Another key indicator is employment. If businesses are cutting back on staff or hours, it can be a sign that they're struggling and a recession may be imminent. In addition, economists also look at measures of consumer confidence, like the Conference Board's Consumer Confidence Index. If consumers are feeling pessimistic about the economy, they're likely to spend less, which can further contribute to a recession. Tips to protect your finances during a recessionary period. If a recession is coming, there are some steps you can take to protect your finances. First, it's important to have an emergency fund in place. This will help you cover unexpected expenses if you lose your job or have a decrease in income. Aim to save enough to cover 3 to 6 months of living expenses. Second, try to pay down your debt. This will reduce the amount of interest you're paying and free up more cash flow each month. Third, consider investing in assets that tend to hold their value during economic downturns, such as gold or real estate. For instance, if you're looking to buy a home, you may want to consider doing so before prices start to decline. Finally, remember that recessions don't last forever. The economy will eventually rebound and start growing again. So don't make any rash decisions that could jeopardize your financial stability in the long run. Remember that you can weather the storm if you're prepared. Now that you know a little bit more about recessions, take some time to review your finances and make sure you're prepared for whatever the future may hold. So what do you guys think? Could the Fed's policies lead to a recession in the United States? Do you think it needs to be more cautious in its monetary? Let us know in the comments below. If you like this video, please give it a thumbs up and subscribe to our channel for more informative content. As always, see you next time!